Hi, everyone. So before we get started, just some quick notes to the audience as people are starting to come in. So first of all, welcome to IREI Live. This is the Defining Opportunity Sets in Real Estate Debt. My name is Chase McWhorter. I'm the Managing Director at IREI, overseeing the Institutional Real Estate Americas platform. Obviously want to thank everybody for joining us. Just some background on the program and kind of to set the stage. So our IREI Live program essentially was, it's the virtual version of essentially our VIP platform. So our in-person conference, this is essentially how we recreated that virtually. Get some experts on a panel to talk about specific things that are important to the investor community, because at IREI, that is our focus, to discuss the investor information needs. So we created this program to be a resource for everyone. So after today's webinar, we'll be sending all the attendees a recorded link to review for future reference. And then also a number of our sponsors of this program have sent us white papers and things like that, so you can review further information afterwards. And then following on that, if you click on each of the sponsors on the link, you can see more information on their website. So I do want to thank our sponsors, going through the list here: Heitman, KKR, Madison Realty Capital, Nuveen Real Estate, Principal, and Trawler. So want to thank all of our sponsors for making this possible, underwriting this program. So again, we can get this information out to the investor community. Real quick, talking about the session, just to kind of, again, set the stage. So this is going to be broken into three parts. The focus is real estate debt. Really the reason we included this as one of the webinar topics is basically the feedback we got is with yield compression, low rates everywhere. There's a serious interest in real estate debt, and it continues to grow. So good news today, we have a lot of different views on real estate debt, strategies, vehicles across the risk curve for investors to choose from. So we're going to go through multiple different ways of addressing it. So the first part of this webinar is going to be a more macro view. We're going to be going through defining opportunities, a general case for real estate debt. After that panel, we're going to go to the next one, which is defining opportunities in mezzanine and subordinated debt. And then the third part is defining opportunities in senior debt in private and public markets. So it'll be a three-part webinar, obviously starting here with our first panelist that we'll get to in just a second. A few other housekeeping notes. I want to make sure the audience, again, as people are coming in, that this is designed to be interactive, not only between our panelists asking each other questions. We'll start it off with some questions we have predetermined, but we want the audience to feel like they can engage. Send us questions. There's a chat icon where you can go through and type in questions that you might have. About halfway through each panel, we'll start utilizing those questions from the audience. So as we're going through, make sure to think of things that you want to ask the panelists. And just in general, again, this is meant to be our panelists talking, our audience engaging. This is not about me or IREI talking. We're just meant to facilitate the discussions. Everybody wants to hear from our panelists and the audience questions that we might have. So starting with the first, this first segment, I'm done with my opening. That's as much as I'll do, hopefully, when it comes to talking here. So to start our first panel, again, this is defining opportunities. It's the case for real estate debt. So we're starting at a macro level here. We have our panelists here. I'll let them introduce themselves, and then we'll go into the question. So to start, we'll start with you, Chris.
Yeah, sure. Thanks, Chase. And thanks for inviting me to this panel. My name is Chris Dewey, Senior Managing Director with Principal Real Estate Investors. For those not familiar with Principal, we are a top 10 global real estate investment manager. We have a little over 95 billion of AUM, and we're active in all four quadrants. And for us, that's both private and public debt, as well as private and public equity. I head up our private debt portfolio management team. In the private debt quadrant, we have roughly 24 billion of AUM, and we've got clients active across the risk spectrum, including core, bridge, subordinate debt, and construction lending.
Perfect. Thanks, Chris. Jump over to you, Greg.
Excellent. Thank you. Good morning to everybody on the West Coast, and I guess good afternoon to most of the rest of us in other parts of the country. But my name is Greg Leadhelm, and I oversee our private debt platform here at Heitman. Heitman is a real estate specialist. We manage roughly 46 billion in institutional assets today, and that's really managed across three complementary business units, similar to what Chris just touched on. We're active in real estate private equity, real estate private debt, which is my charge here at the firm, and then real estate public equity. We're a privately held firm. We've been in business now 55 years, and I'm one of the senior partners of the firm, and have been in the industry now since the mid-1980s. So I've seen a few ups and downs along the way, but I'm still doing it. So at least I'm going to hang in there for now.
Perfect. Jump up to you, James.
Yeah, thanks for having me, Chase. So I'm a member of an investment officer with SWIB. SWIB manages roughly 130 billion investment fund for the active and retired public employees of Wisconsin. Of the 130 billion, roughly 9 billion is in our private markets real estate portfolio. And we have an investment team of 7 people that source, underwrite, and manage the composition of the real estate portfolio, which is benchmarked against the NCREIF Odyssey Index. I'm sure many of the audience knows is an equity index. So we are an equity real estate investor that tactically utilizes commercial real estate debt investments to enhance the risk and return of our portfolio. SWIB has a multi-decade history with private commercial real estate debt investments. And post GFC, we have managed anywhere between 5 and 10% of our portfolio in mortgages and high yielding lending, and have found that the allocation to be beneficial as added diversification, income, and downside protection. Also, the laddering of the maturities can assist with managing our liquidity and vintage risk. So with that, I'm glad to be part of the panel today and just to share thoughts from an institutional investor perspective.
Perfect. Well, thank you, James. And again, thanks to all the panelists for this first part. So again, one more time, just to remind the audience, around halfway through this segment, you can use the Q&A option for your questions to the panel, and we'll ask these for the panel. So again, starting with the first question, kind of at a very high level, and maybe we'll stay on you, James. So, I mean, from your guys' perspective, I mean, what are credit markets telling us about future opportunities in equity and debt spaces today?
So when we look at the market today, it's there's a lot of capital, and so we're trying to obviously find the right approach. And again, we're more of a kind of blended core plus investor across our portfolio. So when we look at opportunities, there's certainly the more sought after property sectors right now from an equity standpoint, and generally those coincide with both equity and debt. So you're looking at industrial apartments, some specialty property types, life science that are have plenty of capital and good transaction volumes to participate in. And then you have other sectors that are a little bit lagging behind. So think of CBD office, retail. And so when we look at where potentially the opportunities are, we're looking at not only debt but equity, and then also geographic locations. And I would say that at a high level, we are finding commercial real estate attractive at SWIB versus other asset classes. You just look at for example, high yielding corporate bond market, and on a real return basis, there's not much to be had there. And so when we can potentially go into a more privately negotiated, well-structured, good sponsorship transactions and get into, call it a 7 to 8% return, we find that attractive for our portfolio.
Mm-hmm. Chris, any thoughts?
Yeah, I'd probably start with just a macro comment that the commercial real estate credit markets, they're healthy, operating efficiently. The cost of debt, at least in my opinion, is supportive of equity valuations. Kind of look across all the lending sources, whether it's bank, life companies, debt funds, CMBS, agencies. There's really no shortage of capital right now.
Mm-hmm.
A lot of debt out there trying to find the right investments. I'd also say across the risk profiles, for the most part, there's plenty of capital, whether it's core, the bridge, transitional space, subordinate debt, construction lending. It's all getting done today. And I'd agree with James. There are some challenges where the capital's being the debt capital is being more selective. The CBD office profile is a little tougher these days unless you have long, weighted average lease terms to get through this. B and C regional malls, it's really tough ask. Hotels, tough ask. But beyond that, I think it's a pretty efficient market.
Mm-hmm. Maybe jump to you, Greg. I mean, thoughts on that as far as credit markets, what are they telling us? And also wanted to stay on you with one of these other questions, but just in general, kind of credit markets, what are they telling you?
Yeah, kind of staying on the same theme or same vein of discussion. I mean, certainly as the economy is, continuing to rebuild from the public health crisis, it's been a little bit of, a couple steps forward, maybe one back, but, property investors are quite appropriately asking questions about where, when, and how to commit capital into a market experiencing, vast different elements of a recovery today. As Chris just alluded to, there's a plethora of capital, not just in real estate, but anywhere. So, I try and think about it as, always investing along a continuum. And, one thing that certainly I think merits consideration for real estate debt, it can work no matter what the economic circumstances are, right? So if you think about market peak versus market trough, certainly if you're going from a peak to a trough, you're going to be experiencing deteriorating conditions, and it's a very defensive posture. When you're in improving conditions, which I would argue we're in today, we are seeing spread compression, we're seeing more aggressive lending posture, and there's just so much leverage available. But then you just kind of pivot. Where do you want to focus your lending strategies during that time, whether it's property specific or even geographic specific? So, we'll probably get into a little more deeper discussion about some of the challenged asset classes. We all know that industrial and multifamily have been the belle of the ball so far and continue to be so, but there's still plenty of areas of opportunity depending on what your tolerance is for where you want to operate in the risk continuum.
And again, staying on you, and you kind of alluded to kind of from maybe what you've heard from investors as you're talking to them, but I mean, really kind of jumping to the last question here. So why is real estate debt attractive at this point in the cycle? And I know across all cycles, it can have different components you want. I mean, one of the things we've heard is just, especially where core equity is when it comes to cap rates, yields, kind of just indirectly driving or directly driving people to debt. I mean, is there anything else from what you're hearing from investors as to why it's attractive at this point in the cycle?
Well, I think it really goes to the essence of it being defensive in its posture, right? Mm-hmm. When you're in a debt position, you're protected. You're protected by that sponsor equity, which is, is always going to bear the first loss position in the capital stack. And also, if there's volatility or changing cash flows, which we all saw certainly during the early days of the pandemic, you're going to be insulated from that. So, I like to think about it, or certainly we think about it as a key component to somebody's portfolio, to be just that, to be in a defensive posture and have that insulation whenever you experience times of volatility. So the same could be true when, if you feel assets are priced for perfection right now, right? I mean, certainly we've all seen aggressive run up in valuations. So, that could lead you more into a debt position if in fact you're concerned that there could be a market correction.
Mm-hmm. What about you, Chris? A similar kind of views you're hearing?
Yeah, I think Greg hit on some very, very good points. If I kind of break down our different investor profiles for our core, our clients focus on the core space. It's really discussion around relative value. You know, they can put more money into corporate fixed income or look at the relative value proposition for core mortgages. And then for our clients that are more interested in the higher risk strategies, say subordinate debt, you know, for us, we tend to play in the risk profile that throws off a 6 to 8, 7 to 9 type return, with quite a bit of that being current return. So, you know, that type of current return versus you know, unlevered equity, it's pretty attractive, and you get a defensive position with an equity subordination. So getting it right on the asset market selections probably first and foremost these days,
Mm-hmm.
just given the market conditions.
Mm-hmm. And jumping to you, James, and if you want to elaborate on that again from your perspective, kind of the shift into this, but another thing that maybe relates to, again, becoming more defensive where things are at valuation wise on the equity side. I mean, other things that keep getting brought up, obviously interest rates being low and inflation. The prospect of it, had a glimpse of it, I guess, early in the summer. So, I mean, as far as key themes and trends related to interest rates and inflation, does that impact your decision-making process, or is it kind of purely just looking at maybe where equity is and wanting to shift into a defensive position?
So we do look at kind of where equity is pricing first and foremost.
Okay.
In addition, we look at, you know, where we think we are in the economic cycle, and look at, you know, credit spreads and relative value versus cap rates. In terms of inflation, you know, there's ways that you can still play it in the debt space with, you know, floating rate loans and putting in floors, also participating in development or participating mortgage loans. So we do find that it still can play a valuable place in our portfolio in an inflation environment, and which would also tend to play well in certain sectors on the, you know, fundamentals recovering and being in a well protected position in a real asset class. So yeah, we look at a lot of different factors, and again, we kind of bucket or think about debt in our portfolio as a 5 to 10% allocation, and we had brought it up to 10 to the higher range, 10%, in 2019, as we thought the equity markets were getting a little ahead of themselves, and that played out well during the pandemic. And here we're still, you know, we've had a number of those loans repay, so we're still at the higher end of our range, and we like that position. Okay. And you know, how quickly it's been amazing to me to see how quickly the transaction volume and equity has come back in. You know, at the beginning of the year, our thoughts were one thing, but then, you know, come first quarter, second quarter, when the economy started opening back up, and you saw public markets really trade up, the bidding tents on the equity side, you know, filled up pretty quickly. Again, for the more sought after property types. So that's where we start, you know, again, thinking about maybe moving into a little bit more of a hedge position on the debt side. Okay.
Well, and staying on that, as far as property types, the different sectors, subsectors, I mean, obviously we've heard industrial, multifamily been probably leading the way the last however many years. But I mean, as far as what you're looking at when it comes to property sectors, and we kind of have it framed as most and least desired, but I think we kind of know the most. I mean, are there any of the least desired ones that maybe from a debt perspective are looking more attractive? So things that might have been out of favor, office, retail. I mean, does from a debt perspective, does it become more attractive? You stay on you, James.
It can, yeah. So,
okay.
And again, a lot of it will come down to the individual tenancy in those buildings and the duration of those leases, understanding the local dynamics. But yeah, I would say that, there's been a few opportunities on the retail and office side. We've done more so in the debt space. We haven't acquired a retail property in, I don't know, close to eight years or so. And so, yeah, it gives you an opportunity to get a different exposure, kind of an idiosyncratic risk that we do find, again, with the right, people sourcing opportunities and thinking through all those dynamics, that you can still find a place to do, your comfortable position in the capital stack, depending on your risk level.
Jump to you, Chris. Again, when it comes to most and least desired property types, and I think debt being a different way, as James put it, to access it with minimal risk. I mean, are you looking at anything that might be quote unquote out of favor still, maybe on the equity side?
Well, maybe I'll focus on the debt side. What I do on a daily basis. Retail, I'd say you almost have to, you got to bifurcate retail. And we've never been huge mall players. We do have some in our portfolios. Again, the B and the C regional mall today, it's just that's a tough bid on the debt side, at least in my opinion. And we really don't have any clients asking us to go there yet. But grocery anchored retail, if we could find more of that, we'd certainly do more of it. I just got to be honest, we haven't seen much come through the pipeline over the last 18 months or so.
Yeah.
Office, we are doing office. Probably a quarter of our debt volume so far this year has been office, but it's a bit different. We've done some CBD office, but it comes down to, you got to have a really strong rent roll with long leases to see through the next few years in the headwinds. We're doing more suburban office as we watch tenants kind of change locations and go out to the suburbs around different cities. And I think Greg might have mentioned this. We spent a lot of time over the last 18 months doing more research, gaining more knowledge in some of these alternative or niche sectors. We've done storage on the debt side for quite a while, trying to do more of it. Medical office, trying to do more of it. Life science, data centers. That's picking up more importance or more allocations through the different indices on the equity side, and we're trying to do a bit more on the debt side as well. We all can't just do multifamily and industrial.
That's a different way of me wording that question.
Yeah.
Obviously, those have been very, very attractive. So it's what else is out there, again, from the debt perspective that you can get into? Maybe jump to you, Greg.
Well, yeah, I mean, Chris kind of cracked open the door. I think to the extent you're willing to wade into the pool of more specialty assets, that's perhaps where you can still garner a little bit of additional yield or return on your debt capital. As we look at that, they've kind of performed a little bit differently. Storage was a beneficiary of stable demand, certainly through the pandemic. Student housing generally performed better than what everybody thought. For any of us that have college-age kids, you found out pretty quickly that they did not want to stay at home and continue to live with their parents. So you had to pay to send them to school so they could do this, but at least from a dorm or a private student housing property. And then, certainly, senior housing took it on the chin pretty hard, of course, with the lockdowns and the various health restrictions, but we're starting to see green shoots there. And then, of course, the great paradox today is hospitality. Are you willing to wade in there? As we all know, CBD or urban hospitality that appeals to business travelers is still suffering quite a bit, particularly in mainline business markets like New York, Chicago, San Francisco. You can pick any of the bigger municipalities, but leisure-based has been a star. I mean, we got some hospitality in our portfolio, and it's quite stunning to me the rates that some of the drive-to leisure properties are garnering today. It's quite spectacular. So I think those are areas where if you're willing to pursue that, and maybe it's even in a higher yield wrapper, you can get some excess return versus what Chris and James already touched on, industrial multi is priced for perfection, but it still needs to be a primary component probably of anybody's debt portfolio.
Yeah, and that is, I mean, reference retail as well, from the bifurcation of retail. Same with hospitality. I think there's been a lot of that across a lot of the different sectors that I think the headline grabbing, yeah, retail dying. I mean, it's definitely different. Same with hospitality. So finding those opportunities. Just a quick reminder, again, as far as the Q&A function, because we have some questions coming in, I just wanted to remind the audience that we'll be able to address those. So start thinking of questions you might have for these guys, and we'll probably get to that in the next 5 to 10 minutes. But yeah, start submitting questions now, and we can start working through it from the audience. So when it comes to, again, as far as trends that you're looking for, kind of what is it that you're trying to watch when you're looking at different sectors, when you're looking at, yeah, debt markets in general? What are the trends, whether you're hearing it from investors, what you're looking for? And I think this would be more kind of different markets as far as urban, suburban. What are the trends from a debt perspective that you're looking for? I mean, many conversations we have, people looking at U-Haul stats, things like that, as far as where people are going. But I mean, are there any trends when it comes to, again, a debt perspective that you're looking for as far as finding attractive markets? Maybe start with you, James.
Yeah, so I guess at a high level, we look at lender surveys and try and understand if, the more traditional bank lending, how active they are, and in what part of the market. We're a little bit more flexible, I would say, in when we're doing debt and expanding the market reach. So, i.e., going into more secondary or even tertiary markets, if it's the right asset in those. So if you can get a little bit more yield and kind of similar quality credit, we think that's a good trade-off, and a little bit more affordable to where people are migrating towards. And so those are things that we look at. I would also say we, in all cases, we use external advisors that are on the ground, very smart people, like people on this panel that help us source and give us ideas to the best way to find, and again, sometimes it's just for us speed helps in securing a transaction. In addition, size. So I would say it's more of those factors than maybe specific market, at least at my level.
Okay, maybe same to you, Greg. I mean, is any, just piggybacking off James's comments, I mean, any views on that from that perspective?
Yeah, I mean, certainly as far as trends, they follow kind of typical demographic analysis and patterns. I mean, we obviously try and leverage extensively off our ownership experience as we lend as well, to try and determine which markets do we think are, good points of entry, if you will. So you're not just aggregated in kind of all coastal markets or in top tier markets that everybody's going to. So, you can often find those seams, but of course they tend to be timing because the market is so efficient. If you think you're one of the first people to go into a certain product type or a certain market, others will generally follow pretty quickly. I don't want to take this off on an extreme tangent here because it's probably worthy of a whole different panel, but one of the more topical debates for us right now is really the whole element of ESG, right? Particularly the E component, because demographically there's no question that patterns of migration are towards future environmental issues, right? You look at a city like Phoenix that is become one of the highest growth markets in the country, and of course has potential water issues. Does that mean you won't lend or buy in Phoenix? Probably not, but that's certainly a trend that's become a lot more topical for us internally.
Yeah, Chris, any thoughts on that? And you can say on the ESG, I mean, I guess at a high level, ESG, from maybe stay on you real quick, Greg, from an ESG perspective, I mean, is it more difficult as a lender to have a say to impact those kind of decisions versus, again, being on the equity side? Is it?
Yeah, I think it is. I mean, certainly as a owner, you can choose, right, whether you're going to invest in a certain market or ultimately, buy an asset that may qualify for certain components of a LEED certified building or meet your environmental targets.
Mhm.
In lending, the only, I know the agencies have some programs specifically targeted to that where there's discounts, right? But
Yeah.
ultimately, when you're a debt provider, it gets a little trickier, right? Because you're typically looking for elements that may be structurally a little more important to you. So we haven't necessarily waived something off because of it. It's just usually a topic of discussion and debate
Okay.
in our investment committee.
Chris, any thoughts on that?
Well, I think Greg's spot on from a lending perspective. Certainly, as a firm, ESG is important, and certainly ESG aware, and more influential probably from our equity side than the debt side.
Yeah.
We do talk about it quite a bit. It is ESG factors are in the committee packages when we go to investment committee. But one of the hard things from a lender's perspective is you may have the ESG profile, whatever that may be, going into a loan. But then what happens if your borrower doesn't continue, investing the money or, keeping intact the ESG characteristics that you thought you had? Maybe they fall away during a loan term, and then what do you do? So I think it's gaining importance. It's certainly gaining conversation and discussions. I think the lending community will figure this out over I don't know how many years it's going to take to figure out the best approach, but certainly an important topic.
Mm-hmm. Well, and again, like we said, we wanted to get the audience engaged. So again, we had some questions come in. So the first one that I think is, again, we've been prepping for this meeting the last month, but just this week, probably not a total surprise. One of the first questions is about the default of Evergrande in China, and how could that impact debt markets in the U.S.? Will it, or is it something that would be contained to just that region? So maybe stay on you, Chris, and get your thoughts on that.
I was hoping you were going to go to Greg. Yeah, I have to admit, I don't have a good educated answer to that question. Certainly we're watching it, just kind of hit the press, Monday.
Yeah.
We don't have any Asian assets, but could the government thread the needle and ring fence it and keep it out of the global credit markets? That seems to be a big ask in my mind. But again, I don't have a terrific answer for you. We're watching it.
Mm-hmm. Yeah, I think one of the things I read was I think they have a payment coming due to foreign investors coming up.
I think it's today.
I think
it's today. Yeah.
Okay. Yeah, Greg, how you guys are looking at it?
This is a unfolding situation, and I don't see any immediate contagion that would permeate into North American debt markets now. If there's something more macro that starts to impact our economy, certainly that could have a trickle down effect, but it's really hard to forecast at this point. Of course, China is such a unique economic animal as to how they contain or not contain problems. It's really hard to speculate at this point.
Yeah. Well, and I guess, James, staying on you. I mean, do you have any thoughts on it?
I don't have any unique insight on the situation other than what's been reported in the press, and obviously the public markets had a little scare, but seems to have calmed down here recently. So if I guess generally what I would say is when things like that happen, maybe not to the same level, but for example, like a taper tantrum or those type of periods. We try and look for opportunities to place capital during those periods. So if it presents opportunities, we have the capital and kind of flexibility to pursue things that maybe weren't available or in a more heated market. So if there is any softening, we look forward to seeing some of those.
Yeah.
Yeah, that's a good point, James. Because we've had bouts of volatility for various reasons. Every couple of years, something roils the markets and things reprice in the credit side. And same thing, we've been lucky enough or fortunate enough to have clients willing to go with us in bouts of volatility and find a few deals that we really like the risk return and reprice for at least a bit, and we can all participate. So that's a very good point.
Mm-hmm.
Yeah, if you really think about it, the majority of what many of us do in the private debt market, they're typically shorter term investments, right? I mean, especially if you're going to be in the bridge sector. The other side of the house, I'm sure for Chris, it's the longer term fixed rate loans, but you have the opportunity to reprice your capital quite often, or maybe even exit your position if in fact you get caught one of those times of adjustment or volatility. And of course, as James said earlier, most of what we do is on floating rate spreads, so it's going to kind of self-correct anyways, and maybe you even get a little benefit if in fact you've got a floor or something. So I think most private debt strategies, again in North America, are pretty well protected against any potential volatility.
And going back to the Q&A from the audience, and I guess even before going there, I mean, want to go back to the panels. Like I said at the beginning, I mean, having questions for each other, additional comments. I mean, want to make sure you guys know that you can ask each other questions as well, if you have that. But obviously, we want it to be interactive between you guys with the audience. We've got about 15 minutes left. So again, to the audience, you have some time to keep sending in questions, and we'll filter through them. But jumping to one of the questions that came in, I think obviously you kind of kicked it off with ESG, but someone did want to know just more specifically what kind of factors are going into investment committee presentations. So from a lending perspective, I mean, is it purely environmental? Is it looking at social? I mean, what would you say is the biggest thing? Just kind of more looking at it from an E perspective when it comes to ESG? Maybe stay on you, Greg.
Yeah, I think it's all the above. I think the E is probably in the lead right now because most firms are a little more in tune with that currently, and that's just been the first wave of ESG. So they're all taken into consideration. But when we go to investment committee, we have a separate analysis that's prepared to address all those components that we look at, and of course, it calls out anything specific, whether it's seismic, whether it's wildfire risk, whether it's heat stress, whether it's water stress. And again, it doesn't mean we won't necessarily do it if it kind of trips over a certain limit, but at least you're acknowledging such. And then ultimately looking at it really from a portfolio standpoint, because all of us have loans on assets in markets that are impacted by these factors, right? So you just don't want to be too terribly exposed. Not to get too granular, but as James can appreciate, we've got a large investment on their behalf that is a hospitality property in California, and it was dramatically impacted by wildfires over the last several years. Fortunately, ultimately incurred no damage, but several times it was at risk, right? It'll ultimately turn out to be a great investment, but that's something to consider, when you look at those same type of opportunities in the future. So it's out there, the information is there, the analytics are there, and then you just have to ultimately, gain your comfort to move forward.
Mm-hmm. Yeah, Chris, any experience kind of in things that have been requested of you from that perspective, or getting into those discussions? Or again, is it on the debt side? It's not something that comes up a whole lot.
No, it does come up. But to Greg's point, I think Greg hit most of the environmental factors I could think of, and that's certainly leading the conversation so far. Throwing energy usage as well, and rising sea levels. Something we're looking at on the coastal markets when we're doing a debt transaction. Maybe the only other thing we're doing here for specifically for one of our clients is on the low-income housing tax credit side. We've been doing that probably a decade. We have a limited appetite, but it's a really obviously a very positive program out there from affordable housing standpoint, and it's a good investment. So other than that, I think Greg probably hit on all the primary factors.
Mhm. Is there anything you look for, James, when it comes to ESG, or is it something more maybe holistic for SWIB? There's just across.
It's holistic, and we probably spend more time on governance on our end,
Okay.
more than the individual asset location. Obviously, we have advisors and consultants that help out on that end. So from our perspective, it's governance, it's the sponsorships, reputation in the market, and how they have acted on behalf of their investors in the past, and what kind of social mindset do they have.
Okay. And staying on you, James, one thing that had come up, we had our editorial advisory board meeting about 2-3 weeks ago now, and we talked about debt, we talked about core, where pricing is right there. And I was just going back to your comment, kind of being on the higher end now of your debt allocation. Does that come from like purely just an overall real estate allocation, or is it pulling from other fixed income? Is it coming from core? Are you transitioning out of core into real estate debt? I mean, how are you guys looking at when you're increasing your allocation? I mean, where does that come from, I guess?
So it's all within the same private real estate equity portfolio.
Okay.
And so, yeah, it's a risk return trade-off in regards to probably more our core value add sleeve of our portfolio on the equity side. Mm-hmm. And so then that's essentially leads to kind of our somewhat narrow range of that 5 to 10% allocation within our portfolio. We do have outside of our team at SWIB, there are folks that do a little bit in the CMBS and the public security side, but that'd be outside of our 8%. That's our target real estate allocation.
And Greg or Chris, I mean, as far as maybe conversations you have with investors, I guess just again reflecting on our meeting a couple of weeks ago, James's comments. I mean, is that usually the trend of where it maybe comes is kind of that shift away from maybe that core equity where it is pricing, moving more into debt? Is that maybe what you guys hear as well in talking to investors? Start with you, Greg.
Yeah, I would generally say that's probably true. I mean,
okay.
I think there was a little bit of, certainly a pause over the last year or so in capital flowing into some of the, let's say, lower returning, but some of more of the, the bridge debt strategies that might deliver a, 6, 7, 8% kind of return. And a lot of that capital is maybe aggregating towards some of the higher yielding strategies that we'll probably, I know you'll get into in some of the next couple of panels. Mm-hmm. That's probably starting to level off a little bit now. But I think, there was certainly a thesis that coming out of the recovery, there would be some, more opportunity. And of course, the holy grail about distressed debt, which has never really materialized either. Mm-hmm. There's some, people that aggregated capital trying to chase those higher returns. But I would say it's generally smoothing out now. I think there is opportunity across that spectrum still, but we are seeing more capital flow into certainly our bridge debt fund. So I would say that's, probably consistent with most of what investors are thinking.
Okay. Did you have thoughts on that, Chris? And I was going to start with one of the audience questions with you as well.
Well, the only thing to add would be our insurance company clients, including our own general account. It's really a relative value thesis versus corporates, and to help with asset liability matching. Okay. And then the other clients, to Greg and James' point, it's either coming out of their real estate allocations or their credit / fixed income. Just really depends on the strategy.
Mm-hmm. Well, and again, staying on you, Chris, one of the questions from the audience. So with the increase in non-traditional debt sources, such as debt funds, is there a concern that this could drive a pricing bubble? Is that something you guys think about? Is it something you hear from your investors? Yeah, so I'll start with you on that one, Chris.
Yeah, as Greg knows, there's been a lot of debt capital raised in the debt fund space, including we've got a series of debt funds. We're on our third right now and likely launching another one next year in 2022. Pricing bubble, I think at least for the deal flow we look at and try to participate in, underwriting seems to be holding up. Of course, valuations have gone up quite a bit across the industry, but lenders seem to be behaving from an underwriting standpoint. Yeah, spreads have come in, but again, then it's a discussion on relativity. And a levered return on a bridge loan or a subordinate debt return that we used to get 8 to 10, which we really liked. Now it's 6 to 8. Well, then it's back to relativity, and you're looking at different real estate strategies. And is 6 to 8 a good return relative to alternative strategies? So I wouldn't say a bubble, but there has been a lot of money raised, no doubt.
Yeah. Well, and
Oh, sorry, Chris. Chase, I just
no,
thought
yeah, I was going to jump to you, Greg.
Yeah, I think the market is so much more educated and disciplined today, right? When you talk about creation of bubbles and, being obviously somebody who participates in the sector of the private debt markets, the inherent discipline is there. And if you think about many of the folks represented on this panel, these are firms that have had a long-term commitment to private debt investing, have seen the market ebb and flow, and have worked past some of the issues that occurred even, before we all went through the global financial crisis. So I don't think it creates a bubble. I think as you think about the debt markets, it's always a somewhat shifting pie chart. Mm-hmm. And where the private market participates, it probably has just picked up bandwidth away from some of the public sectors of the market that have been a little more volatile. But still, if you think about banks and life cos being the biggest component of the other 30-40% of the market, there's a stable share now picked up by the private element of the market, and it's fairly disciplined.
Well, and that was even going to be my kind of follow-on question to that is, well, yeah, you might see an increase in the non-traditional. Are there decreases in other places that kind of filling in that gap? I mean, is that a good way to look at it?
Absolutely. I mean, as you saw, a lot of private market participants enter even post global financial crisis. It really was filling that bandwidth that the public markets vacated, of course, with all the volatility, particularly in CMBS at that time.
Okay.
Mm-hmm.
Yeah, because it's not, the way that I would look at it is just, it's not more capital competing for the same, it's kind of filling a vacuum for.
That's right.
Okay. Any other thoughts, James, on that?
So I was actually just going to throw out a question to Greg and Chris, since you offered that up for the panelists. So in terms of capital flows, what's your team's kind of currently seeing from foreign investors on what they're thinking about maybe on the commercial real estate debt and how attractive U.S. is versus maybe their home markets? Either one, Chris or Greg?
Yeah. Go ahead, Chris. Sorry.
Oh, I was just going to throw out, and I appreciate that. We do have large foreign client on the private debt side, and we've been working with them now 2 to 3 years, and their allocation to the U.S. is coming out of their credit department. So not the equity side, not the straight fixed income, but out of what they call mid-market credit. And they do have a very talented real estate equity team in-house. So they kind of come together and listen to the deals we're underwriting and recommending for them. But they've certainly leaned in to the U.S. On the private debt side. They like larger deals. They don't mind complexity, and the returns they can get here relative to home country, it's really attractive for them. And that's probably the biggest foreign source we have right now.
And I think, James, the concentration of our foreign capital within our different debt fund products tends to aggregate mostly from Asia and Australia. The Asian investors historically like debt for a lot of the reasons we've already touched on. But we've seen quite a bit of increase in Australian investors. And it's really the superannuation funds in Australia that very sophisticated, very knowledgeable, tend to move in large chunks of capital. And, as you start to think about their home market, it's fairly constrained, right? I mean, Australia's got a population that's about the same size as the state of California. So, you really have to think more externally if you're looking to grow substantially. So that's been the biggest concentration of foreign capital we've seen is from that part of the world.
Mm-hmm.
Okay. Yeah, where I was kind of thinking you're going with it is that it does seem like, obviously global capital flows and reproduction costs and, somewhat limited supply, you got pockets of a little oversupply, but we at a macro level aren't overly concerned about, just a commercial real estate bubble. If other things happen, commercial real estate will be susceptible to it. But I don't think, again, at this particular point, that commercial real estate, lending or debt markets would be the catalyst for a bubble to burst.
Mm-hmm. Well, and we got to note that, again, we got about 8 minutes left. Want to have time for your guys' key takeaways. But wanted to send one last reminder to the audience. If you can type quickly, you can send us over another question. But I guess the follow on to even James's comment as far as global capital flows, when it comes to a bubble, and this kind of goes back to the first one as far as the bank in China. So looking back to the GFC, I mean, just in general, because again, this first one is talking about kind of at a macro level. You guys are giving kind of the macro overview. So just in general, from the debt markets perspective, are there any connections, correlations to the GFC? Is there any kind of red flags that you're seeing that are concerned, or has the debt markets become a lot more disciplined? I think would be kind of my view, especially in the US. I mean, maybe start with you, Greg.
Yeah, honestly, I have not really seen any correlations to what we all lived through in the global financial crisis. That was really a crisis of leverage and overcapacity. You think about what was happening at that time. You had debt and equity all kind of squished on top of each other. People were making debt investments that were really invading the equity space and calling them debt. It was really an ultra aggressive time. And of course, the leverage that was in the marketplace was extraordinary at that time. So I haven't seen that. I think, as I said, from my perspective, the participants in the debt markets have maintained discipline. I mean, sure, everybody competes on the margin, and the competition has really been more centered on cost of capital and availability of capital than it has been erosion of underwriting standards or excess leverage.
Mm-hmm. Yeah, Chris.
Yeah, I think Greg hit it spot on. Just thinking back to pre-GFC before it all kind of hit. Greg's right. It was debt and equity, all the way up to 98% for some of the bridge programs out there is a 80% bridge loan. The lender would bring another 18% of the stack in terms of pref equity, and things were levered up about as high as you could go. And then you throw pro forma underwriting on top of that. It's just a recipe for disaster. And obviously it finally did get there. But again, I think I mentioned before, I'm seeing the same trends. I think there's still discipline in the debt markets. It's really, we're not competing necessarily on LTV. It's more on, to Greg's point, kind of a cost of capital. Who's got a more efficient mousetrap to bring the financing to the table versus let's quote another 5 or 10% leverage. Just not seeing that.
Mm-hmm. Well, and with a few minutes left, again, wanted to wrap this up with just getting your guys' kind of final thoughts. Again, we started this with just kind of the title is The Case for Real Estate Debt. I mean, this was meant to be kind of a macro view, kind of how the world's shifting to debt. So again, just want to get kind of your guys' final thoughts, parting thoughts for the audience before we wrap up. So we'll go left to right, and we'll start with you, Greg.
Well, I guess just to try and, tie it up in a neat bow here, with the uncertainty still somewhat, present in the U.S. and the global economy. I think coupled with some of the variability across different sectors, I think, real estate debt is still a great aspect of anybody's portfolio. So incorporating the defensive traits we've all touched on here over the last 45 minutes in a private credit strategy, should be an attractive part of anybody's portfolio. So that's the way I think of it. And I think hopefully folks will agree.
Mm-hmm. Chris?
Yeah, I just view private debt today and looking forward. It's really attractive sector for most investors. You have asset liability matching needs. Core plus mortgages are a good place to go. You can tailor loan terms. You can go fixed. You can go float. Just depends on what the investor needs. And for the clients that need higher returns, you can get it via the debt, floating rate debt, and probably go into sub debt or bridge lending and get an attractive mid to higher mid, single digit type return, and most of it's current. So, and most of that is floating rate. So if you're worried about inflation, you have some protection too. So then you always have the equity cushion to be a bit defensive.
Mm-hmm. Perfect. James?
Yeah, in terms of the way we think about it, there is clearly the added benefits to our portfolio, the direct benefits of the higher income yield, diversification, downside protection. One that is a little bit harder to measure or quantify would be just as a institutional investor, the knowledge that you gain from putting your debt hat on and talking to lenders and seeing how they're viewing the market and getting to know different players, and it opens up opportunities to provide capital maybe multiple ways to a good operating partner. So that's another benefit that we found.
Mm-hmm. Well, perfect. And I mean, again, I'd say the key takeaway I have is just in general from, again, a macro view is just really this shift. Again, reason we're having this panel based on the feedback that we've gotten from investors. Hey, can you do one of these IREI lives on debt? I mean, I think you're seeing at a macro level, a lot of people shifting, trying to get a little bit more defensive, not necessarily maybe a concern as far as the markets, but just where core is pricing right now, just wanting to shift a little bit, as you guys, James, obviously went kind of 5 to that higher 10%. So yeah, obviously very timely to have this discussion. Want to thank all three of you for this first part. So you can turn off your cameras, mute, obviously advise or request you stay around to hear kind of the other perspectives. And we'll bring in our next panelist. So I want to thank the three of you for kicking us off here. So thank you.